Hello everyone and welcome to my channel. In this video we're going to talk about Lucid Motors, trading under the ticker symbol LCID. We're going to talk about the recent price actions, the technicals, and the best trading approach given the circumstances. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and to subscribe to my channel. Lucid has always made a special niche for itself as one of the few EV manufacturers that actually has a currently viable product that is been sold. The reason why so many people are interested in buying Lucid is because for a very long period of time, it was viewed as a small Tesla or a US-based NEO with the potentials that these companies have. That it allows people to benefit from an increase from a very early stage. During the heydays of the 2020 bubble, the market has clearly been convinced that whatever the stock promised at the time will be delivered, which explains why the stock went to a historical high of $55. We're light years away from this assessment, and it's fair to say that at this current stage, Lucid is not only viewed like a normal car manufacturer, but also dragged down by the change of perspective and the outlook of the EV sector itself. As we speak, the financials are showing that Lucid's revenue did not really significantly increase over the course of the 2023 quarters, and that the supply chain issues that plague the EV sector continue to do so. This is why I would recommend a cautious outlook for Lucid in the upcoming year, especially considering that economy is likely to enter into a recession. With that being said, let's also take a look at the technicals. The trading volume is around 21.4 million shares, compared to an average volume of 41 million shares. Over the previous 52 weeks period, the price fluctuated between $3.62 and $17.81. The volume of shares traded tells us how many shares being bought and sold at any given point in time, and if there's enough liquidity to support a trading strategy. If the float is super thin, it would be very easy to push the stock price around, but the low liquidity could also mean that the demand will be limited. When we compare the current volume against the average volume, there might be the possibility for a trend reversal or breakthrough were the difference very large. If the stock were to break through, the current volume would be significantly higher than the average volume. The market cap is currently around $9.8 billion. As we compare the current price to the historical price fluctuations, the stock is 7% higher than the 1-month low, 18% higher than the 3-month low, and 18% higher than the 52 weeks low. Now, on the options market, which often gives us a hint about the stock market sentiment, the implied volatility is 85% compared to a historical volatility of 74%. The put-call volume ratio is currently around 29%. It is normal for many stocks to have a higher put option volume than what they deserve because many institutional investors hedge their long positions by buying put options. The most recent volume of options traded is 39,000 contracts a day compared to the 30-day average of 74,000. Regarding the open interest, the most recent volume of open interest is 1.8 million contracts versus the 30-day average of 1.7 million contracts. In terms of the shareholder structure, institutional shareholders own 74% of the total float, which is very important. The biggest shareholders include Vanguard, BlackRock, and Invesco. Usually, it's always good to see some institutional participation in holding a stock long term because it offers a layer of stability and reliability in the medium to long term. It means that the market is confident overall that it's going to deliver value, which is very important to consider for investors. I personally recommend to have a threshold of around 30% for institutional ownership if you want to hold the stock for more than a year. Current short interest is around 30% of the total float, and 51% of the transactions are coming out from the dark pools. Usually, if the short interest is above 15% of the total volume, and that a significant portion of the short volume comes out of the dark pools, it may suggest that there are institutional positions taken to short the stock and that there would be potential for a short squeeze. Overall, I would recommend to have Lucid as part of an EV portfolio, and that the stock has its relevance in the wider context of trading the EV sector itself. I don't believe, however, that any significant takeoff will occur in the short-term future, except maybe when Gravity SUV gets released. For those seeking quick gains, Lucid may not be your best stock, but for those looking for an exposure in the stock for medium to long term, especially an exposure in the EV sector, this might be a decent choice as long as a disciplined purchasing and selling behavior. Of course, analyzing securities from a fundamental perspective is always helpful, but it should be complemented with extra external forces at play. Investing in stock market can sometimes feel like riding a roller coaster with its many ups and downs. This roller coaster may seem arbitrary if we compare the company's operational reports and its share price action. It is profoundly influenced by real-world uncertainties, central bank decisions, and many other intricacies between the real economy and the stock market. Even if the end result may differ from their participants, the stock market is deeply intertwined with the pulse of the world, and real-world uncertainties can significantly alter and affect its delicate balance. Events like elections and geopolitical tensions can often trigger fluctuations, leaving investors and citizens around the world alike on the edge of their seats. The mere speculation of a change in political leadership or a brewing conflict can cause stocks to sway, let alone when those speculations turn into the grim, dark reality. If the recent events have shown us anything from an economic perspective, it's quite obvious that the market participants will show less reassurance in the state of the local economy and the stability of our societies. Additionally, we must face the fact that the looming risks of a recession may cast a shadow on the market. When economic indicators hint at a potential downturn, investors may become jittery, leading to heightened volatility. It is crucial to understand that the stock market isn't solely driven by the cold, hard numbers, but also human emotions and perceptions that play a significant role in shaping the market dynamics. We can actually argue that our collective and subjective perception of the future is more important than the objective facts, and that our personal impression from the immediate surrounding can affect our perception of events that happen very far away. And within these immediate surroundings is the central bank, a key player in the financial orchestra. The interest rates set by the central banks have a profound impact on the stock market's rhythm, especially for exchanges like Nasdaq, where the tech companies often dance to a different tone. When the interest rates rise, the borrowing becomes more expensive, affecting the profitability of those companies. For the more speculative tech companies that often operate on the thinner profit margins, or in fact, negative profit margins, higher interest rates can be particularly challenging. Investors may reevaluate the risk associated with those companies, leading to sell-offs and increased market volatility. Conversely, the lower interest rates can create an environment conducive to borrowing and investing, potentially boosting the stock prices. One perplexing aspect of the stock market is its ability to march to its own beat, seemingly detached from the real economy. While the economic indicators may point to a struggling or booming economy, the stock market may tell a very different story. This divergence becomes particularly apparent during periods when the real economy is faltering, yet the stock prices continue to rise. This phenomenon can be attributed to a variety of factors. Central banks' interventions, government stimulus packages, and investors' expectations can all contribute to this disconnection. It's essential for investors to recognize the fact that the stock market is not a perfect reflection of the real economy. It is rather a complex system influenced by a multitude of variables. When managing all these complexities, investors are wise to exercise vigilance and to broaden their perspective. Looking beyond the fundamentals of individual stocks, it becomes crucial to consider the macroeconomic and monetary landscape. Understanding how global events, central bank policies, and economic indicators interact can provide a more comprehensive view of the investment landscape. Macroeconomic factors like the inflation rates, the employment numbers, and trade balances should be on the investor's radar as well. Likewise, when keeping an eye on the central bank communications and policy decisions, they can offer insights into the direction of the interest rates and the overall market sentiment. Above these elements, that are all individually important to consider, there is also another one: the idea or the concept of cyclic movement. It is one thing to assume that things will always come and go, the good like the bad, but it's quite another to assume that the next cycle will look exactly like this one. The current market may be towards the end of a super cycle that began with the collapse of the 2008 real estate market and the quantitative easing that followed. A massive amount of capital has been injected in the market for more than a decade, and this has played a significant part in the recovery and later the takeoff of the asset prices. These policies may not come back, and there may not be the same kind of recovery that we have enjoyed after the last market collapse. The past doesn't guarantee the future, and it is no different this time. So, really, the stock market is a dynamic and intricate ecosystem influenced by an array of factors. Real world uncertainties, central bank decisions, often arcane relationships between the market and the real economy all make up to what we see on the stock market. In this ever changing landscape, investors should be well served by adopting a holistic approach that considers both fundamental analysis and macroeconomic perspectives. By staying vigilant and embracing a multifaceted view, investors can navigate the stock market with a far better understanding of the forces at play. I would recommend to commit between 0.5 to 1% of your portfolio in Lucid, and would also recommend to split the allocation in batches of 20% over the next 3 to 6 months so that you can purchase more in retracements.